There's a lot of different investment strategies. You've heard mine, but to be fair, we want to talk about some others. Today, we're going to talk about the 3-bucket philosophy. What is it like? Does it work? And what do I think about it? Let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor. What you hear in this channel, I do apply to our practice. So please do consider subscribing as we do regular market updates, latest right here, educational videos like we're doing today, live market updates every Monday, and a whole bunch of other stuff. So if you've been around my channel, I talk a lot about my process. That involves looking at the cycles, moving to the cycles, looking at the charts, which is called technical analysis. But today, we're going to look at something different. Seen some articles recently, so have to be open-minded. Let's take a look at the 3-bucket philosophy. All right, been here before, talk about my cycles, we know that, but always open-minded. Saw a couple articles on this recently and wanted to revisit it, look at it. No, I'm not changing, but in all fairness, let's look at this strategy, the 3-bucket theory. Cash flow, transfer, and longevity, okay? So the idea is your first one's your cash flow, 1 to 2 years funding, okay? Emergency savings and liquid assets. First off, 1 to 2 years is a lot, all right? We tell folks 3, hopefully 6 months. Now, if you're in retirement and you've got your regular income, pension, Social Security, you probably don't even need that. Newly retired, we say about 6 months just in case things happen with air conditioners or whatever else. So that's number one issue I have here. Now, what are you going to fund this with? As you would expect, money market and CDs. How are they doing right now? Well, we know with the Fed at 0 interest rates, not too well. Treasuries, yes, nice secure vehicle, but the 10-year as of today, recording this early February, is about 1.9%. Okay, inflation is 7, by the way, so that doesn't work out too well. And then you've got some of your guaranteed income streams, pensions, Social Security, and fixed annuities. So that is your first bucket, which is cash flow. Next up, bucket number 2. You have to look at inflation, of course. Now, inflation again is the highest it's been since the 80s. So here they're saying investment grade bonds, blue chips, and REITs. All right, so let's think about this for a second. Investment grade bonds, it depends. Again, when you look at my cycles, last year when we were in cycle 2, 2021, November of 20 to 2021, we weren't really in treasuries or investment grade bonds, right? Why? Okay, because when yields go up, prices go down. Why be there? Okay, so that's why I don't like that concept. You have to be in flux when the market moves. Okay, blue chips, sure. Everyone likes blue chips. I get this question all the time. Can I get more dividend stocks? Especially right now when we're seeing some volatility. Sure, but it doesn't mean they're not going to be volatile as well. And believe me, I could give you some names that have been crazy volatile right now, despite getting a 1, 1.5, 2.5, 3% dividend. So sure, good markets, nice concept. And in REITs, which are real estate investment trusts, yes, I like that as an investment. I was in that business for a while. But that being said, again, it can be cyclical and you have to be careful with that. All right, so the next thing is, as you spend money in bucket 1, you're gonna fill it with good old bucket 2 here, okay? And the same goes from bucket 3, moving down to bucket 2. You've taken on some risk, you're gonna move it down the chain. Our third bucket today, okay, is long-term funding, so higher risk, large cap growth, small cap, technology, right? All the things that you would expect. Commodities is listed, Yes, no, and it's literally yes or no. Again, going back to November in our cycle 2 call, we made that call for inflation and commodities. Great place to be, all right? We're seeing that roll over a little bit. Oil staying sticky at this point, but commodities is definitely cyclical, okay? So like them as an asset class at the right time. Let's apply this to some age groups, okay? So the first thing, age 30, you've got plenty of time, accumulate savings and ride out market swings. Okay, no question, right? You might choose to put 25 into bucket 2 and 75%. Yeah, maybe, right? I mean, it depends. If we're in a good market, if you're young, you should be willing to take on some more risk, especially in your 30s, 40s. As you get older, sure, maybe that number should change. Age 50, just 2 decades. I guess they're saying you're retired 70, right? After retirement, you're gonna split between 50-50. I don't agree with that, okay? Again, I think when you look at last year's market, which is strong, okay? If you were 50-50, you left a lot of meat on that bone. So you gotta be careful. When the market's going well, I believe you gotta run with the markets. Age 60, you're getting close, a split of 75% and a split of 75% in bucket 2 and bucket 3 might be appropriate. You know, again, here's my issue, and I'm gonna kind of wrap this up here. What I don't like about it, one, it's very stringent. It's not easy to manage, okay? But again, I think this is my philosophy. 2 things. One, the markets are cyclical, okay? I say cycles, 1, 2, 3, 4. And in each cycle, some things work really well, some work really bad, okay? And that could be tech, that could be commodities, whatever the case might be, bonds, right? Some of the things they mentioned today. So I think this idea of trying to manage this way, one, it's gonna be difficult to get what? Return. And I gotta tell you, we are judged on return as advisors. Yes, I think a cornerstone is a financial plan, but if you're not bringing return, that financial plan doesn't work. The next thing is, okay, when we are in good markets, like I said, I think you gotta run with it, right? I've told my clients, if you're in a 60-40, I might go to 65, 68, 70% because the market warrants that. There's been a philosophy, and I talked about this. I did a video about why the 60-40 portfolio no longer works, why I don't think this works, okay? One is the concept of buy and hold, right? I watched the video, I just don't believe in it, okay? The other thing is, when you look at that model, the theory is, and big companies do this, they take 100 minus your age. So you're 70 minus 100, you should be 30% in equities. No way. Same goes for here. If I did that in 2021, I would have been fired by the majority of my clients, okay? So I think that, to me, being tactical, okay, proactive, move with the cycles is going to help you over the long term, right? As far as market swings that buy and hold, I don't believe that. We have a high cash position right now as we prepare for some volatility, okay? What's anticipated is Fed raise interest rates, okay? Because it's not what you make, it's what you keep, and that's a big part of wealth management, managing risk, and also making sure our clients are good over the long term. Hopefully that was helpful. Any questions, let us know. Michael Loftus, Wealth and Wisdom TV.